I can summarise the result yesterday by saying that they produced a number that was less than we had forecast, but a lot better than the market had feared. So that's why you had the bounce yesterday. It basically it exceeded what a lot of the more bearish people had been predicting, and just the commentary around the second half was a lot firmer than we had the same time last year. Basically, the company said that 60% of their second half capacity has already been sold. So that just tells you that meeting their new guidance range of between 90 million and 95 million dollars EBITDA is going to be pretty easy for them to meet when you've pre-sold that much. Basically, the story with the first half was that basically the outdoor business, which is the roadside billboards, actually did really well. It was running sort of about 8% revenue growth. Unfortunately, the smaller units, which are transit, which are buses and bus shelters, those sort of things, and rail and airports were quite weak, and they all went backwards. So instead of getting double-digit growth in the first half, they got high single-digit. Not a disaster. And I think they themselves admitted that basically with those smaller divisions, they admitted that they were distracted by the merger, got a bit lazy and didn't really put in the sales effort that was required. They are predicting that the second half of those things will be better. So we've recast our forecasts. We've come back to the middle of the guidance range for our forecast. And we still think that there's value left in this thing. Our valuation has come back to $5.73, and our blend of our price target, which is a blend of the DCF, a PE multiple of 16 and an EV to EBITDA, gives us a price target of 5.76. So we still think that there's still some room to go in this stock. They are even with the capex they've got on these new screens. They've got another 24 under construction in the current period. They're still more than capable of funding dividend growth over the next couple of years. So I think the market was basically trading on fear in this stock for the last few months. Now they've realised the worst of their fears haven't been realised. So it should continue to perform well over the next few weeks, in my view. Just in terms of the way we look at this stock over a sort of a 3-year view, what we do is we assume that the static billboards business continues to go backwards. So we've got that going backwards at a rate of about 3 to 4% a year, the static business. But that's more than offset by the digital billboards, which have just in this last period have just switched over and become more than 50% of revenues. So when this company listed on the exchange, I think digital billboards were about 25%. Digital's now just over 50%, and the digital share will keep growing. So we think the growth story on the digital transition is still intact for at least another 3 years. And so on that basis, we think you get 3 years of pretty solid dividend growth, financed from cash flow, and on our forecast, even with the capex numbers that we have intact there, the company will still be building up cash, a net cash. So to us, it looks like a fairly sort of low to medium risk play on domestic advertising growth.